£3,800. That's the average overpayment British retirees handed HMRC in the 2024/25 tax year because they didn't do 8 specific things within their first 12 months of retirement. Your employer never told you about them. Your pension provider assumed someone else would. And HMRC, quite deliberately, buried the instructions across 4 separate guidance pages, 2 helplines, and a form most pensioners have never seen called P50Z. The result is staggering. 1.4 million UK pensioners paid tax they didn't legally owe in a single year, and fewer than 1 in 5 ever claimed it back. Gerald Whitmore, 64, from Swindon, retired on February 28th after 38 years as a logistics supervisor. He expected a smooth transition. Instead, by April 6th, HMRC had applied an emergency tax code to his private pension withdrawal, taken £2,100 he shouldn't have owed, and placed him on a PAYE code that assumed he was still earning his full salary alongside his pension. Gerald spent 11 months trying to sort it. He got the money back eventually, but only because his daughter happened to be a payroll administrator who recognized the coding error on his first pension payslip. Most people aren't that lucky. Most people don't even look at the tax code on their pension paperwork. And that's precisely what HMRC counts on, because every month you overpay and don't challenge it, that money sits in Treasury coffers, earning interest that will never be yours. Here's what HMRC expects you to do, and what happens to your money when you don't. I'll walk through all 8 obligations in order of urgency, starting with the one that costs retirees the most, and ending with one almost nobody knows exists. Some tax professionals argue that items 6 and 7 on this list are technically optional. Others insist HMRC enforces them quietly through coding adjustments. The ambiguity itself is part of the problem. But first, the one that catches nearly everyone. The moment you stop earning employment income, your tax code must change. That sounds obvious. It isn't. HMRC operates on a cumulative basis. They assume, unless told otherwise, that whatever you were earning in April will continue through March. So if you retire in July, HMRC has already allocated your personal allowance across 12 months of expected employment income. When your pension provider starts paying you, HMRC often applies a BR code, basic rate, meaning every penny of your pension is taxed at 20% with no personal allowance applied at all. For a pension paying £14,000 a year, that's £2,800 in tax on income that should have had £12,570 of it completely tax-free. This is thing number 1. You must contact HMRC and inform them of your exact retirement date, your final salary figure, and the date your pension payments begin. You do this by calling 03002 003300, the income tax helpline, and explicitly asking them to issue a revised pay code to your pension provider. Don't wait for them to do it automatically. The system is supposed to update through real-time information from your employer's final payroll submission, but in practice, HMRC's own internal reviews found that 23% of coding notices in 2023/24 contained errors during employment to pension transitions. Nearly a quarter. If you're sitting at home assuming it's all being handled behind the scenes, there's roughly a 1 in 4 chance it isn't. Margaret Fellows, 66, from Harrogate, didn't make that call. She'd been a secondary school receptionist for 22 years, earning £24,500. When she retired in September 2024 and began drawing her teacher's pension of £9,800 annually, plus a small private pension of £5,200, HMRC split her personal allowance incorrectly between 2 pension sources. One pension had a 1257L code, correct. The other had a BR code, meaning the entire £5,200 was taxed at 20%. That's £1,040 taken that shouldn't have been. Margaret didn't notice for 7 months because, in her words, I thought the tax people knew what they were doing. They did know what they were doing. They were collecting revenue on the assumption that silence means consent. I'd be curious to know, has HMRC ever applied a BR code to your pension without explanation? Because in comments on previous videos, hundreds of viewers reported exactly this happening, and most only discovered it when they compared their expected pension amount to what actually landed in their bank account. If that's happened to you, write the tax code you were given in the comments. I want to see how widespread this still is in 2025. Thing number 2. You must claim back any overpaid tax from your final employment period. When you leave employment mid-year, you've often paid tax as though you'd earned that salary for 12 full months. Since you didn't, you're owed a refund on the difference. HMRC won't calculate this for you automatically. You need to submit Form P50Z if you've stopped working entirely, or Form P53 if you're taking a pension lump sum. The P50Z specifically tells HMRC, I have stopped working, I won't be working again this tax year, and I want my overpaid tax back now rather than waiting until April. Without this form, you wait, sometimes 6 months, sometimes until the following October when HMRC finally reconciles your record and sends a P800 calculation. David Cartwright, 67, from Ipswich, retired in August 2024 from a manufacturing firm. He'd earned £31,000 annually. By August, he'd already paid £3,680 in income tax through PAYE, but his actual liability for the 5 months worked was only £2,486. He was owed £1,194. David didn't submit the P50Z because nobody told him it existed. He received his 800 pesos in November 2025, 14 months after retirement. The refund came eventually, but 14 months of HMRC holding over £1,000 of his money, interest-free, while his savings account paid him 4.5% on far less. Now here's where it gets worse. Thing number 3 is the one that catches higher earners completely off guard, and some pension advisors still debate whether HMRC applies this consistently or selectively across different regions. Your pension lump sum, the 25% tax-free cash most people take, can accidentally push your remaining pension income into a higher tax bracket for the year you retire. This sounds counterintuitive. The lump sum is tax-free, so how can it affect your tax? It can't directly. But here's the mechanism HMRC uses. When your pension provider reports your total pension access to HMRC via real-time information, the system sometimes misreads the crystallization event and temporarily codes your regular pension income as though your total annual income is higher than it actually is. This particularly affects people who take their lump sum and begin drawdown in the same tax year they leave employment. Joan Prescott, 63, from Chester, took early retirement and accessed her SIPP in the same month, October 2024. She took £45,000 tax-free lump sum and began drawing £1,200 monthly in Flexi Access Drawdown. HMRC's system saw £45,000 plus projected annual drawdown of £14,400 plus her 5 months of employment income, and issued a tax code that assumed she'd earn over £60,000 that year. She was placed on a 40% tax code for her drawdown payments. For 3 months, she paid £480 per month in tax on drawdown that should have been taxed at 20%, or in her case, partially within her personal allowance. Total overpayment, £1,440 in just 90 days. Fixing it required calling HMRC twice, waiting on hold for a combined 2 hours and 40 minutes. And that's not an exaggeration, that's consistent with HMRC's own published average call waiting times for the 2024/25 period. Thing 4. You must tell HMRC about every source of income you have in retirement, not just pensions. Rental income, savings interest above your personal savings allowance, dividend income above the £500 dividend allowance, and any part-time or freelance work. If your total retirement income exceeds £12,570, you owe tax on the excess. If it exceeds £50,270, you're into higher rate territory. HMRC expects you to register for self-assessment if your untaxed income exceeds £1,000 in a tax year. Many retirees have small rental incomes, £3,000 or £4,000 from a spare room or a buy-to-let, and assume it's covered because they pay tax on their pension. It isn't covered. It's additional income, and if you don't declare it, HMRC has up to 20 years to investigate and apply penalties of up to 100% of the unpaid tax. If any of what I've just explained made you pause, and given the numbers involved, I hope it did. Hitting the like button takes 2 seconds, and it signals to the algorithm that this information matters. That means more retired viewers see it before April, when coding errors become locked in for the full tax year. 2 seconds from you could save someone else 4 figures. Thing 5. And this is the one that separates retirees who pay the correct tax from retirees who overpay for years without realizing. You must check your tax code every single April, not once, every year. Your HMRC personal tax account, which you access through Government Gateway, shows your current tax code, what income HMRC thinks you have, and what allowances they've applied. After retirement, your circumstances change frequently. Savings interest fluctuates, pension increases apply, state pension rises with the triple lock. Each of these changes can nudge you into a different tax position. Yet HMRC doesn't send you a letter every time they adjust your code. They update it electronically, send a digital notification to your tax account, and if you haven't logged in since 2019, you'll never see it. Here's what most people don't connect. Thing number 2 and thing number 5 are linked. If you overpaid tax in your final employment year and didn't claim it back immediately, HMRC sometimes corrects it by adjusting your tax code the following year. That sounds helpful, but the adjustment is often wrong because it's based on projected income, HMRC estimated, not your actual income. So you get a refund built into your code for year 2, but the code also assumes income you might not be receiving. The errors compound. By year 3, your tax code might bear no resemblance to your actual financial life. Richard and Ann Baxter, both 69 from Tunbridge Wells, discovered this compounding error in 2024 after 3 years of incorrect coding. Richard's pension income was £22,400. His tax code assumed £26,800 because HMRC had carried forward an estimated bank interest figure from 2022 that was no longer accurate after interest rates changed. Over 3 years, he'd overpaid £1,860. Anne's code had a similar error with an old P11D benefit that related to her final employer's medical insurance, a benefit she hadn't received since retirement. Her overpayment, £940. Combined household loss, £2,800. They only caught it because Richard's golf partner mentioned checking his own tax code and finding an error. Thing 6. You must understand the marriage allowance and decide whether to claim it or cancel it. If one spouse earns under £12,570 and the other earns between £12,571 and £50,270, the lower earner can transfer £1,260 of their personal allowance to the higher earner, saving £252 per year. In retirement, income levels shift. The spouse who was the lower earner during working life might now have a higher pension than their partner. If the marriage allowance is still active in the wrong direction, one spouse loses £1,260 of allowance while the other doesn't benefit, because they're now below the threshold themselves. HMRC doesn't automatically reverse this. You must apply to cancel or switch it via your personal tax account or by calling the helpline. Some tax professionals say HMRC should flag these situations automatically. Others point out that the department's systems aren't designed for proactive taxpayer support. They're designed for collection. Either way, the responsibility falls on you. Thing 7. If you receive state pension, understand that it's taxable income, but it arrives without any tax deducted. This confuses thousands of new retirees every single year. Your state pension counts toward your total taxable income, but unlike your private or workplace pension, no tax is taken at source. Instead, HMRC adjusts the tax code on your other pensions to collect the tax owed on your state pension through those payments. This means your private pension payment is reduced by more than you might expect, not because the pension itself is taxed at a higher rate, but because it's carrying the tax burden for your state pension as well. Patricia Keeling, 67, from Norwich, received a full new state pension of £11,502 in 2024/25. Her workplace pension was £8,400. Combined income, £19,902. After subtracting her £12,570 personal allowance, her taxable income was £7,332. Tax owed at 20%, £1,466. All of that £1,466 was collected through her workplace pension, meaning her £8,400 pension actually paid her only £6,934 into her bank account. Patricia called her pension provider furious, believing they were stealing from her. They weren't. HMRC had simply coded her workplace pension to collect tax on both income sources. Nobody explained this mechanism to her before retirement. Nobody at the DWP. Nobody at her pension scheme. The system assumes you already know. If you've watched this far, you're clearly someone who refuses to let HMRC profit from confusion. Subscribing to this channel means you'll see the video I'm releasing next week on the 5 state pension traps that catch even financially savvy retirees. Because what I'm covering there directly builds on everything we've discussed today. One click now saves you searching later. And thing 8, the one almost nobody knows about. If you retire before age 66 and have no earned income, you might need to pay voluntary Class 3 national insurance contributions to protect your future state pension entitlement. Each missing qualifying year can reduce your state pension by roughly £328 per year for the rest of your life. If you retire at 60 and reach state pension age at 67, that's potentially 7 missing years. 7 times £328 equals £2,296 per year less in state pension permanently. A single year of voluntary Class 3 contributions costs £824.20 in 2024/25. You pay £824 once. You gain £328 every year for the rest of your retirement. If you live 20 years past state pension age, that's £824 invested for £6,560 returned. There is no savings account, no ISA, no investment fund in Britain that offers that return with zero risk. Yet HMRC's own data from January 2025 showed that over 400,000 people approaching state pension age had gaps they could fill but hadn't done so. You check your national insurance record through your personal tax account on gov.uk. It shows every qualifying year, every gap, and whether each gap can still be filled. The deadline to fill gaps going back to April 2006 was extended, but it won't remain open forever. HMRC hasn't confirmed publicly when the extension ends, but internal communications suggest a final cutoff is being discussed for April 2026. Now, connecting all 8 of these together. Each one seems small on its own. A wrong tax code here, a missed form there. But the system creates a compounding effect that most retirees don't recognize until they've lost thousands. Thing 1 leads to thing 3, because if your code is wrong when you take your lump sum, the overtaxation is immediate and large. Thing 5 prevents things 2 and 6 from drifting into long-term errors. Thing 7 explains why your pension feels smaller than promised. And thing 8 determines whether your state pension will be full or permanently reduced. The system wasn't designed to help you understand it. It was designed to process you efficiently. And efficiency, from HMRC's perspective, means collecting revenue first and correcting errors only when challenged. Your Monday morning plan looks like this. Monday, log into your personal tax account on gov.uk and check your current tax code. Write it down. Tuesday, check your national insurance record for gaps and note any years showing as incomplete. Wednesday, call 03002 003300 and ask HMRC to confirm your coding notice matches your actual retirement income. Have your pension figures in front of you. Thursday, check whether your marriage allowance is still active and flowing in the correct direction. Friday, look at your April pension payslip and compare the tax deducted against what you'd expect based on your code. 5 days. 5 actions. That's the difference between retirees like Gerald Whitmore, who spent 11 months fighting for his money, and retirees who catch these errors in week 1. Gerald, incidentally, did get his £2,100 back. It took until January 2025. HMRC paid no interest on the money they'd held incorrectly for 11 months. No apology letter. No explanation of how the error occurred. Just a quiet adjustment to his tax code and a modest check in the post. His daughter told me, off the record, that when she called HMRC on his behalf and quoted the specific section of the PAYE regulations that had been violated, the advisor went quiet for 10 seconds, then said, "I'll escalate this today." It was resolved within 2 weeks of that call. 11 months of waiting. 2 weeks once someone who knew the rules applied pressure. That's the pattern. HMRC responds to precision. They rely on confusion. When you replace confusion with specific knowledge, form numbers, code references, exact figures, the balance shifts. Not because the system becomes fair, because you become harder to ignore. You spent decades paying into a system that promised to look after you in retirement. The least that system can do is tax you correctly. But it won't do it voluntarily. You have to force accuracy by knowing what they expect and doing it before they penalize you for not knowing. In the next video, I'm covering the 5 HMRC letters that retirees receive in their first year, and which ones you can safely ignore versus which ones require immediate action. Because one of those letters contains a deadline that, if missed, locks in an incorrect tax code for an entire year. That video drops next Thursday. 8 things, 8 actions, £3,800 at stake. The only question is whether you'll be the retiree who checks or the one who trusts the system to get it right on its own. In 40 years of working life, how many times did the system get it right without you watching?